My name is Trishal from the Finmango India initiative, and we're particularly excited about having Beni on board for this talk um, for many reasons. But I think, in the spirit of MPP, the degree we both hold, I think it's worth mentioning that the work that Beni does with the Future of Finance initiative in Dwara Research is what we consider to be the ideal middle ground between the praxis and the academic knowledge that we have when it comes to financial literacy. I think there are two poles under which we operate. The first being, say, the technical interventions into this field. If you don't mind me saying, the tech pro approaches, wherein we have sophisticated applications both on the web or on the phone coming into the market, and we also have a larger market that can't really adapt to these changes. And the second pole then comes in your banking system, which follows the same old traditional processes. But when it comes to banking about the next billion people, about alleviating poverty, about challenging inequality, what we need is a bridge between the praxis and the theoretical knowledge that we have into this and technological interventions. And we think that Dwara, and particularly the Future of Finance initiative that Beni has dwelled herself into since graduating college, is this perfect ideal ground. And with that, Beni, over to you.
Sure, for that really generous introduction. One quick sound check. Am I audible? Trishul, maybe you could...
Yeah, Beni, you're audible.
All right. So what I'm going to do is I have a very small PPT. It just shows that I was way off the chart in the previous poll. I'm way more than 24, and therefore I still believe in PowerPoint. I have a very small PPT to take you through, and I'm happy for you guys to keep popping up the questions in the chat as well as at the end, whichever is convenient. So without much ado, I'm just going to start share screen. Sorry, welcome to my live. Yeah, I'm just assuming that my screen is visible to you.
Yeah, it's visible now.
Cool. Yeah, all right. So I'm Beni Chugh. I work with Dwara Research. Like Trishal said, Dwara Research's focus is on expanding the reach of formal finance to those who are underserved. And what we mean by formal finance, so really the rest of the thing is going to be more like a bad story, my bad attempt at a Hassan nudge. But the two things that I really want you to know before I get onto that PPT is this. Our definition of formal finance, and when I say our, I definitely mean my organizations, but also in the larger policymaker circuit now. Financial inclusion has moved beyond getting access to a bank account, and it has become about getting access to a range of financial services, including payments, multiple options for payments, multiple options for getting a loan, multiple options for getting an insurance product. So it's about the ability of an individual or an enterprise to get a range of financial products at convenience and at affordable prices. So that's what we mean by financial inclusion. It's not the shell of a conversation that we used to have 20 years back where it was just access to a bank account. It's also about access to financial instruments and their frequent and rapid use. And the other thing that I would want to focus on is fintech. So now this is a phrase that really scares me. And after kind of spending 3 years in writing a paper and going to various forums talking about it, I'm still very conscious when I define fintech the way I'm about to. The small point here is that the definition of fintech is still fuzzy, and it's not just my lack of knowledge, but across the world regulators are still striving how to define fintech best. As of now, what we have is, it is the interface of technology and finance. That is when non-financial institutions start using technology to deliver or design financial products. That's what fintech is. And that in itself is not a very easy concept to wrap your arm around, because, for instance, going by that definition, a credit card is fintech, an ATM dispenser is fintech, because that's literally the use of technology to get access. So what is so new about fintech? I think what is so new about this fintech is that it has a lot more non-financial instruments. So there are these very cool algorithmic processors whom Trishal would have called the tech pros. There are also these very cool payment gateway designers who basically say that you can actually make a payment using your credit card from your home, and Amazon gets that money, right? So they're acting as almost a physical point of sale, but it's all on the computer. So there are a lot of non-financial institutions who are making this possible, and the scale at which this is happening is unprecedented. And I think that's where a bit of a nuance is, that how do you really distinguish fintech from the application of technology to finance? I also promised that this was the most academic part of the presentation and the worst is behind you. But I really want to say that when I talk of fintech, I would really want you to think of technological applications that are improving the access of finance by making new business models possible. I'll elaborate a bit when I go in. And what I also want you to focus on is, when I say financial inclusion, I mean a whole range of financial instruments being available to every individual, every enterprise. With that, what am I going to say today? So I don't know. I see that a lot of you are 18, so 18 to 24. So I wouldn't count on history or your past experience now. But if you've been around and if you've been watching this space for about 5 to 7 years, essentially post 2008, you would have understood that there's a lot of exuberance about how fintech is actually the silver bullet for financial. So this presentation that I'm going to make today is kind of highlighting what are the fintech models out there that you could avail of, and what are the kind of cautions that you should observe when you're actually dipping your toes in formal finance via fintech. So that's the scope of my presentation broadly. So I'll first come to financial inclusion. What is financial inclusion? You guys know broadly now. But what is the theory of change? Like, why are we spending so much money, thought, leadership on developing a solution for financial inclusion? What is in it for us? So as we understand from decades of experience, access to finance can be transformative. And what do I mean when I say transformative? If any of you broadly experimented with economics, I was an economist, not the best years of my life, but sure. So you would know that there are two kinds of equilibrium. One is an inferior equilibrium and one is a superior. It's a stable state, but when you're in an inferior equilibrium, what it says is that given your circumstances, you could have been in a better position if you had certain preconditions, certain catapultic factors. And that's literally what finance does. It can actually move people from inferior equilibria to superior equilibria. It can transform lives. And why do I say that? There is more evidence, and I did not make this a very academic presentation, but if I were to count citations, I would probably exhaust all of my 20 minutes. There is more evidence to show that access to finance can lift people out of poverty. It can actually improve the gender balances within home. It can give more agency to people. A lot of social ailments that we actually see have a very important and persistent component of finance, right from the lack of educating girls to kind of the dowry problem that we see in India and how it feeds into the larger loop of male preference. All of these, in some aspects, are smaller financial problems. If the society had enough resources to educate girls for free, there would be lesser people who would not want their girl child to get educated. If there was a financial instrument that could actually make women independent and eradicating the need for dowry altogether, I mean, just on the financial, the cultural bit takes a lot longer. But if there were instruments that could actually come to people's rescue in those times of needs, then people's lives could have been transformed and they could have been jettisoned from an inferior equilibrium to a superior equilibrium. So, and I speak personally now and not so much for the organization. To me, I think access to suitable finance is more of a human right than it is an economic condition of life. If finance has the potential that it does, then it's just a matter of human rights that we should all have access to finance that can positively transform our lives. There are some examples that I've written on the slides. These are literally just words, but happy to go into case towards the end if time permits. But really, if you're all convinced and bought into the significance of financial inclusion, if this is all so great, if it not only has economic welfare surplus, but it also has social surplus to deliver, then what's stopping financial inclusion? Like, why haven't we cracked that code yet, right? So I think this is what is stopping it. The same things that stopped a response to the World War II. And those are just lack of information and imagination. So financial service providers, banks, insurance service providers, lenders, they constantly struggle with these two aspects. What do I mean when I say information? What might be information in this context? Service provider, I'm taking a case of, let's say, a lender right now, someone who wants to give a loan, someone who has surplus money and is willing to lend. They typically look for one kind of ability in the prospective borrower, and that is, will this person be able to repay? So they are really interested in understanding the person's credit worthiness. If I were to give money to this person, will I get the money and the interest back or not? This is the lender's prime concern when they're giving out money. And while that's a concern, it takes a lot of types of information for the lender to satisfy herself that yes, the money being lent out would be returned with interest. What might that information be? It would be someone's ability to earn a living. How much are they earning, and will that earning suffice in their own expenses as well as enable them to repay the loan? Then what are the future prospects of the business that they're doing? So for instance, it might all look very well today, but maybe it turns out that their business is cyclical and things are about to go down the cycle 2 months later, and their ability to repay the loan might actually be reduced quite significantly when their business activity is out of the think of coaching classes, which typically get a lot of interest right before the exam, and there are these whole crash courses type of things that everybody wants to do, and who hasn't enrolled in a GRE program saying, oh my god, 2 months to go, must do this, right? But all of those are like very cyclical businesses, and therefore when a lender is actually lending money, they're not only interested in what you're earning today, but what you're likely to earn over the tenure of the loan, so as to be assured that they will get their money back. So these are some of the concerns that lenders might have when they're giving their money out to you, right? And all of this is typically the lack of information. Now, when lenders do not have a lot of information and they're still willing to take a risk, maybe because they do have a lot of surplus money and their appetite allows them to, what they typically do is they charge you a very high interest rate. So this is risk premium. This is the cost that you pay for not having enough verifiable information that you are worthy of a loan that you want, right? So for instance, if I don't have a job, and if I'm really wanting to take a loan because there is this cool software that I want to learn, and I'm pretty sure after that I'm going to be an Instagram influencer and I'm going to earn, like, I don't know what I want, Kim Kardashian. But yeah, so I have to convince them today that I have potential, but just promise is not enough. So what the lender will actually do is that they will actually factor in that risk that you are saying you will do, but they do not have any verifiable information on your aptitude of kind of executing that promise, or the cash flows that this loan will actually generate for you. So they will give you a loan at not, let's say, 16% or 24%, but maybe at a 50% interest rate, saying that, all right, here's your money, but the interest rate that you need to pay me is quite high. It's 50%. And what the lender really is doing is that even if 6 months down the line your loan fails, they would have acquired a lot of money via that high interest rate already. So they are covering their bases. So this is what a lack of information does. And this is not even the worst case scenario. The worst case scenario would be that I would not get any loan at all. And all my dreams of being an influencer would be dashed, right? So that's the kind of trade-off that we're looking at when we say the difference that information makes in financial income. So the more information you have, the better your chances of getting a formal financial product, and the better your chances of availing of the benefits. That's information. That's great. But what about imagination? Why do we need that now? The point is that not everybody has standard requirements when it comes to finance, right? For instance, one of the most popular products in India is a ROSCA, which is a chit fund type product, which is both a savings and credit product combined. Till today, formal finance hasn't been able to crack the code of ROSCA and create that kind of an instrument formally. And why is the ROSCA so popular? The ROSCA is so popular because it allows people to save it at their own will, and they have a lot of trust in the other people they're saving with, and they know that whenever I want, I will get a loan which is 3x or 4x or 10x of what I am putting in every month. So that's a huge promise. They can actually over leverage their own savings and get something which actually fulfills their needs in that point of time. I know it's a complex example, but if I were to make it a bit more simple, think of a farmer. Now, a farmer in India typically gets incomes in 3 installments, which is when the 3 seasons of cropping end and they go to the market and they sell their produce and they get whatever they do, right? But the rest of the year, if you're just a farmer, you're not likely to have any other source of income, right? Now, to give that person a 12-month equated monthly installment loan product is to expect a lot. These people are likely to get their income in lump only 3 times a year, and it's very hard for anybody to have that kind of financial discipline and foresight to pay back 12 weighted monthly installments. So what that person would actually do is, instead of taking the burden of 12 EMIs when they're only likely to have income in 5 months out of the 12, they would actually go to their money lender. They would actually say, hey, here, you can look at my field. It looks great. The produce is going to be great. I need loan right now and I need it only for 4 months. So how can you serve me, right? And it's interesting because the money lender has both. The money lender has the imagination or the flexibility to kind of serve the farmer according to their needs. They also have a lot of information because they're embedded in that social, cultural, geographical context, and they can literally see what the farmer is thinking of, right? So those are the kind of, it's almost like the dissolution of the geographical and the informational barriers, what we talk of when we say imagination. So until you have both, you have enough information about being able to serve a person and enough imagination to make that product relevant to their lived realities, financial inclusion is not likely to take off. So these are the challenges, but really it doesn't sound hard. I mean, my previous speaker was just talking of such complex, bonds and capex, and we have such sophisticated financial instruments already. So, I mean, it's a relatively simple problem. If someone with just 3 years of experience in the field can articulate it, I'm sure those with 10 years of experience in the field can solve for it. Unfortunately, it's complicated. The reason that it's complicated is it's a typical chicken and egg problem, or what might be more relatable to this group is it's very similar to finding your first job. You want to go get a job. The person who wants to hire you needs you to have experience. You tell them you can't have experience because, well, this is your going to be your first job. So you need the job to get the experience. They need the experience for them to get the job. And that's literally the story of financial inclusion. I, as someone who has no financial history, has never held an independent bank account, the only financial exchanges that ever were involved in my life were some nice relatives giving me some nice gifts for, I don't know, Diwali, Christmas, whatever. And if that's the only financial history that I have, then for me to approach a formal financial service provider and say, hey, give me a loan, I have great talent, is unfortunately not going to move walls, right? So I don't have a history of formal finance. Therefore, I am not able to access formal finance. And therefore, I still don't have a history of formal finance. So it's this vicious circle. Nobody will be willing to take the first risk on me in some sense, right? If I don't have anything to prove that I'm worthy of it. And therefore, this is where we've been stuck for really long until came Fintech, might I? And how did Fintech break this vicious circle? It did actually, and it did in some very interesting ways. How does Fintech help? Fintech actually uses non-financial personal information. This is one example of the things that Fintech does, but I'm really using Fintech as a use case for seeing how they solve the information asymmetry problem. So in that context, Fintech actually uses personal information to design financial solutions. This sounds great, but what is personal information? Personal information like your quirks, like at how many degrees do you do parallel parking, can actually feed into the telematics of your car and can actually tell your insurance provider, this person is a risky driver, you need to up their, right? If it comes to a lender, then every lender these days you'll see kind of hosts an app on your smartphone, right? So you will have an app of that lender sitting on your phone. And what is the point of that app? That app actually sees how many phone calls are you making to your mom every day. If you make more than 2 phone calls to your mom every day in some credit models, by the way, you are a very good credit risk. You're a great person and they're willing to have your back and they're willing to lend you money. As opposed to, do you have Tinder on your phone? If yes, then well, mama trumps Tinder and you would not be considered a very credit risk in this case, right? So each of these lenders are developing their own models, and these are of course some more fun examples, but there are more basic examples like the kind of device that you're using to get the loan, the most frequently visited locations, because that's again an indicator of the geography and upward mobility that you have in your life, and all of those serious parameters also exist, but these fun parameters, I mean, quote unquote, fun parameters also exist. And what do lenders do when they collect all sorts of information? They actually use an algorithm to predict your credit worthiness. As the training data set becomes more diverse and as their lending cycles become more diverse, the algorithm gets more and more precise in understanding which are the indicators that are good indicators of, let's say, people's credit worthiness. And lenders then only start looking out for those 19, 20 indicators, which give them an accuracy of, I mean, I don't know. I haven't, nobody has trusted me enough to show an algo to me, but I'm guessing that the accuracy is quite high, right? So what has it done? It has actually removed that first obstacle in the access to formal. Your in the door is this plethora of personal information that you have on yourself, your entire digital footprint. And then if you successfully repay your first algorithmic credit your first algorithmic score generated credit, that shows positively on your credit history, that makes bigger financial institutions consider you favorable. And then your credit history just keeps improving, your financial information keeps getting richer, and then your ticket size of loans, the products you're offered keep getting more complicated, and more financial institutions keep getting interested in you. So it's literally you're in the door to formal finance, and which is great, right? I mean, I can't see anyone feeling sad about this. And while all of this is like the information solving problem, how is it solving for imagination? And I think that's where technology has an even bigger role to play. So because of technology, because of platformatization and all of those cool things that you read about every day, a lot of new business models are becoming available, right? Earlier, my only option was to suit up, wear my best jacket, coax my mother, coax my father to be my guarantors and visit my bank and say, listen, I'm a good kid, you know my parents, give me some loan. And I had to actually approach the banker myself. But now what is happening? I have a cool idea. There is actually something as simple as a summer school that I want to attend or a symposium where I want to present a cool idea, and I need 3 lakhs of money for that, and my college is unwilling to kind of support me because I have poor attendance. What can I do? I can actually go to a P2P lending platform. I can actually create my own profile, say that poor attendance but great scores, even amazing idea, wanting to attend symposium, needs 300,000, please donate generously, prize money to be won 450,000, will come back and share the spoils of the victory, right? That's all you have to do. And you will see a lot of people who will actually start lending out money to you via that P2P lending platform or the peer-to-peer lending platform. So you really don't have to dress up. You can be in your jersey. You can just make this profile online and you can just leave it to fate and karma to get you some good credit, right? Similarly, there are smaller options like pay later. Now, taking a cab ride in college days, I don't know how many of you could afford it, but it was like a bit of a luxury, right? And when you were taking that cab ride, you would always be like, and this means I might just get 1 drink less at the club or something. But actually, when you got done with the cab ride, the cab sharer actually asked you to pay later. And you were like, whoa, what is this, right? So those simple pay laters where the ticket amount is like 400 rupees, 500 rupees, $20, $25. What is that? That's a very small sachet loan that has been offered to you by looking at the parameters like the device that you've used to call the cab, your previous ratings on the cab platform, your frequency of payments to the cab platform, etc. And you've just been offered a small loan of $20, and you can literally pay that when you get your next pocket. Right? So the imagination is expanding as well. There are so many more business models, ticket sizes, loan amounts that were actually unimaginable. There is this very old for me, so definitely ancient for most people, anecdote that we heard from our seniors, which was like, back in the day, someone at ICICI Bank wanted to actually float a loan of ticket size of only 2,000 because they realized that actually that's the average amount that a rural person needs to kind of tide over their consumption expenses at the end of the month. And ICICI tried their best to create a loan of 2,000 rupees, but they realized that for them to be viable, because their entire structure was so expensive and lengthy, the minimum amount of loan had to be 5,000 rupees. Now, someone who does not have the need for 5,000 rupees and someone whose need is only 2,000, why would they take a loan twice the amount of what they need, pay the interest on that, and actually, why would that appeal to anybody, right? And it might even make them worse off. They might not even have the means to kind of pay for a 5,000 rupees loan. Then those kinds of things have now been resolved with technology, with the ability of finance to integrate into our daily life, into our daily actions, and actually integrate so seamlessly because the technology is now available, while at the same time using all that they can, all that is at their disposal to make sure that the product that comes to us is more relevant, is more timely, and is not kind of packaged or designed in a way that makes people apprehensive about it. So then, is it only us millennials who can actually benefit? I mean, I have nothing against millennials. Honestly, I don't even know if I qualify as a millennial, but sure, I'll just write that way for now. But does Fintech also have the potential to kind of make a more enduring change on more persistent bottlenecks, let's say the MSMEs or the rural sector? Actually, it can. So this is exactly what they do, even for MSMEs, for rural sector. For instance, I'll give you an instance. In India, what is very popular is a tea kiosk. So at every junction, you'll get someone who's selling tea on a ठेला or a kiosk on a thatched roof shop, whatever it is that you call it, right? And it's very hard for anybody to assess how to give them a loan. But you always see that there are at least 10, 20 people out there drinking tea, smoking, especially if you're outside of a law college that has nothing else around it. That tea stall is going to be like overcrowded all the time. And yet there is no means to kind of give credit to that person so that at least they can, if nothing else, they can at least have like a bigger counter or like one more gas hob for them to prepare the tea, right? So what is Fintech doing now? Fintech have actually started digitizing each payment using guess what? Using things like Alexa, using things like Google Home. They've actually started recording. So whenever there is a voice order of, let's say, 5 teas, it then gets digitized saying, okay, 5 sold at 470, 10 teas sold at 425. Now, what is this person become? This person has suddenly become from someone who had no amount of what their no idea of what their sales was, to someone whose sales history is now so well documented, minute by minute, over the years, over the days, over the months. And suddenly now they have verifiable financial information which can actually serve as a solid base for someone to give them credit. And this is what is happening in diverse parts of the country, that there are people, intermediaries, who are actually digitizing cash flows at kiosks, at places which had no sense of any daily books, no transaction receipts, nothing, but they're actually using technology to digitize the transactions that they have day in, day out, to understand their credit worthiness, to understand their loan requirements, the correct tenure, the correct size, and give them credit. So of course the opportunities are immense. Similarly, this is also happening at a larger scale for MSME, where they literally do this. They take into account the tradables, the bills that an MSME has. So a lot of MSMEs upwards apply to bigger global organizations, let's say ITC, let's say Unilever, So whenever they have an IOU from a company which has a very high rating generally, in the market, MSME sees, okay, this bill is not likely to fail. The digital lender has proof that this MSME has actually a lot of, credit worthy kind of or worthy kind of bills that it will encash in the next quarter, and that becomes a great basis for them to lend money. Just right now, as we're talking, there are these very cool organizations who have now actually even kind of transcended the COVID barrier, the shutdown, and offering sachet loans on WhatsApp. So all of that is happening while we are talking, and money is reaching people via fintech. Inclusion is happening, and if inclusion is happening, then well, all levels checked. It like financial inclusion unlocked. Not really. It's complicated again, and
But
this
I'm
time,
sorry, can you just give me a second?
yeah,
Can we start to wrap up now because the African cohort of the event is about to start?
that's great. This is my last slide. That's okay. So actually, financial inclusion is happening, yes, but it's complicated. And why do I say it's complicated? Uh, it's complicated because we as individuals operate with several cognitive biases when we make financial decisions. There's instant gratification, there's inability to assess costs and merits transparently, and there are certain kinds of cognitive biases. Read Taylor, read the book Nudge, and you'll understand cognitive biases that operate on us as humans when we're making long-term financial or any decisions that actually require a lot of bandwidth, right? So what is this doing is it's making all of finance access very easily, and there are no guardrails on when to access it and who can access it, right? So in India, we are seeing that millennials are actually now finding themselves in the midst of a new age debt trap. And what started as a benign, innocuous loan of 300 rupees for a movie soon turned into a 3,000 rupees loan over the months. Now it's somewhere at 9,000 rupees, and college students find themselves unable to pay. The that's sad because it's affecting individuals at two levels. One is it is actually ruining their credit history for a long time to come. If you're actually not paying back, no matter how small your interest payment is, even if it is a dollar size loan, and if you do not repay, it reflects in your credit scores that are being kept at four credit bureaus in the country, and those credit scores actually are a signal for bigger formal financial institutions to lend or not lend. It's something like the FICO score. In India, we have the civil transfer. So what happens is if I'm not able to repay a loan of 500 rupees that I had really taken just to buy a movie or, as they say, self-care, and if I'm not able to repay that, my CIBIL score takes a tremendous beating. So imagine someone who's 18, second year college, who's done this to themselves, and imagine them applying for a loan for a post-grad degree in like 2 years' time, right? This is not going to go away, and it actually affects your ability to take loans for more pressing purposes just because they're so easy to take. I think the last speaker said something like, just because it's accessible does not mean that you have to access it. But there's no one out there who's actually helping individuals make these choices if these loans are suitable for them or not. That's one. Second is the practices of the lenders themselves, and this is not to not to paint everybody with the same brush, but there are definitely lenders who actually benefit from giving away loans, even if they know that people might not be able to repay. So, for instance, there are lending models that focus especially on subprime lenders. I have an example from the Canada, but what they do is the interest rates are anywhere as high as 50%, and even though 80% of the people end up defaulting on that loans, the companies still become or remain profitable. So what you've really done is you have messed up the credit, probably pushed them to the debt trap. You have probably made them compromise on a consumption like that of proteins or of education, and you walked away with a profit, right? What is even worse is that many of these loans are now being kind of catered or administered on digital platforms, And India still has a very high proportion of population that's a first generation user of a digital interface, right? So we don't have a lot of exposure. So what is happening is that many times people don't even know that they actually signed up for a loan. So I have this small example of 110 people where 54 people didn't even know that actually when it said that, hey, there's money in your account, it actually meant that, oh my God, that's a loan. They just thought, wow, there's money in the account, right? So those are the kinds of barriers that we're facing. And though they sound very simplistic, and I might have oversimplified it, the point is that all of this money could, as the previous speaker said, very well be toxic money. So is it all black then? Like just 2 slides back, we thought we had financial figured, and now I'm telling you actually not really. These are all bad people. They're not bad people, but there is a learning curve that's associated. There is a learning curve that needs to look into how people are consuming the products that you're sending, and if they're consuming it for the right purpose. And sometimes you need intervention to reconcile the interests of the provider with the interests of the end consumer, right? And that's the whole point of regulation. So we definitely need like different kinds of regulation. It's no longer about prudential regulation and having so much capital in your first year, second year, not the banking type regulation. But what you need is like more sophisticated regulation. When someone comes up to you and says, hey, I need a loan, can you definitely check how this loan will affect them during their tenure? Instead of checking for will they be able to repay, can you check that if these guys repay, what is the surplus they will be left with? And will they have to make like crucial life trade-offs? For instance, one of our studies shows that people were actually the performance of a portfolio was great. It was 99% repayment, but that repayment was coming at the cost of people not consuming pulses, lentils, and expensive protein, and people just kind of traded off their protein, their health, to only repay a loan. So those are the kinds of considerations that algorithms are actually well placed to make, not the nuanced level of will you actually not consume fish, will take the loan, but at a more broader level of how is it going to affect people's welfare. And those are the kind of tests that providers simultaneously need to kind of incorporate when they're assessing, or those are the kind of variables that should also be seen in algorithms that are used to score people for credit. And of course, then there's this role of awareness, which I personally am not a big fan of. I don't think that it should be on the consumer to understand the product completely, because consumers are not the people who designed it. So, I mean, Mac cannot expect me to understand its PC completely and then make a choice of whether I want that or not, right? So there is some amount of trust and some amount of responsibility that goes when I'm purchasing something from someone. And the same should hold true for finance. I should not be told that, but why did you take a loan? You should have told me exactly what the terms of the loans were and not misguided, right? But there is still a role for awareness. So what I can say is that I know student credit is great. I know our parents can be stingy. I know movies can be competitive. But when you're signing up for student credit, please read forms carefully. In China, unfortunately, we saw that they had actually accessed people's photo libraries as well as phone when installing apps. What that meant was that photos were later held out as ransom, and the lenders were actually harassing young girls on university campuses to make their nude photos public if they did not repay loans. So yes, please read the loan forms carefully. There is a lot of access, but also a lot of caution that we need to exercise. And at least those of us who have the agency and the ability to do so must. And yeah, know your cognitive biases. Know that you're bound by instant gratification. Know that almost every financial product has caveats. Take your time, read up, as the previous speaker said, understand what's going on in the world, and also remind yourself that money is fungible, right? Sometimes what we do is that we have a recurring deposit for, let's say, a new outfit or a new vacation, and at the same time we need a few course books. So we're willing to take a loan for the course books, but not break that RD, right? People earmark money for different reasons. So just make sure that you're not making expensive trade-offs and you're not relying on expensive access when you might have cheaper access. So remind yourself that money is fungible. It can be used in a different form of ways. Be more aware, read more, do more Fin Mango, I guess. And yeah.
Beni, thank you for that. Just going through and traversing both the positives and negatives of what financial inclusion as a concept is going through after the introduction of technology in it is something that's fascinating. Just before I let you go, just one very quick question is that you spend most of your career interacting with and researching people who are stakeholders in this field of financial inclusion. So both for technological and financial institutions, how hopeful are you that their business models, their products, their operations are going to be viable without them having to take up predatory or exploitative practices, anything of the sort? Just how hopeful is all?
I think very hopeful generally because I believe in greater humanity, but also because I do see that even business cases themselves or providers themselves, for those of them who are in the longer run, they do see that pushing people into poverty is basically pushing their own future consumer into poverty, right? So they're eating up their own business. So in a longer run, this doesn't make for a great business model for anybody. That's one. Two, regulators are now actually catching up, and they have their keen eye on what the practices are. So just, I think last week, May 20th, the US had that $20 lending bill, right? Which basically sets out practices that you can or cannot take when you're actually giving a short ticket size. So yeah, kind of actually hopeful, but I would say that that exuberance around fintech being a silver bullet needs to be caveated, and more caution than less is actually desired.
Fair. Okay. Thank you so much, Beni. It was very insightful, and we look forward to our interactions in the future. Thank you.
Thank you so much, Beni, for being a part of this.